today. This is Money Exchange with Andrew Barnett.
Hello, I'm Andrew Barnett and welcome to Money Exchange, the only TV program dedicated to keeping you up to date with everything you need to know about currency markets. It's been a positive week for the Aussie dollar, shifting higher late in the week after spending the first half of the week range-bound without any major economic news. It took off on Thursday along with the global stock markets as traders seem to want to abandon the US dollar. Tonight we'll hear from Tony Sycamore, the Institutional Director of Foreign Exchange at Commonwealth Bank, to find out if the overall downtrend is still intact for the Aussie dollar and how much lower does he think it will go. We'll chat with Steven Dooley from Western Union about the latest news to come out of the US that indicates December is still the likely month the Federal Reserve will hike rates for the first time in 10 years. And if that's the case, then why did traders sell the US dollar in the last 48 hours? We'll have all the answers for you here tonight. I'll also share with you a new international money exchange service that's attracted the investment dollars of Richard Branson and was started by the same entrepreneurs that gave us Skype. If you're sick and tired of being charged outrageous bank fees when you do your international currency transfers, then stick around, we'll save you some money. And what have the big institutions been saying this week? Is there any reason to adjust our expectations of where currencies are likely trending over the coming months? But before we discuss any of that, let's take a look at this week's headlines. China's central bank has taken another step to boost the economy's slowing growth in a move intended to make borrowing and lending easier for banks. The People's Bank of China has cut the overnight lending rate from 4.5% to 2.75% and lowered the 7-day bank loan rate from 5.5% to 3.25%. The Reserve Bank is cautiously optimistic about the outlook for the Australian economy, saying the prospects for an improvement in conditions have increased in recent months. In the minutes of its November meeting, the RBA left the door open for further rate cuts, saying the outlook for inflation may provide scope for further easing if it's appropriate. The central bank is expecting growth to strengthen gradually over the next 2 years. Last time Western Union's Steven Dooley was on the show, the Aussie dollar was trading at 73.33 to the greenback, and he told me the Aussie will likely fall back down. And that's exactly what it did, dropping to 70 cents just over a week ago. To get an update on what to expect from the local currency ahead, Steven joins me from our Melbourne studio. G'day, Steven. How are you? Thanks for your time.
I'm good, Andrew. Thanks a lot for having me on tonight.
Mate, it doesn't appear that the RBA is going to cut rates in December. The US Fed doesn't meet until the 18th of December. I'm keen to ask you what you think has to happen for the Aussie dollar to fall back below 70 cents before Santa comes.
Well, it's an interesting story at the moment because looking at the commodity markets at the moment, we've had a horrendous couple of weeks. We've seen copper fall 12% in 10 days up till last Thursday over the last couple of weeks. We saw crude oil down 8% in a week, and we've seen iron ore down 8% in 2 days. And in that kind of environment, you really would expect to see the Aussie dollar pressured lower. But really, we've sort of again found a little bit of support around that 70.50 level and had a fairly good rebound, particularly in our Thursday session where we had a big break higher. And like you say, there doesn't seem like there's going to be much from the domestic side of things, certainly over the next week and a half, to really pressure the Aussie further lower. We've got a couple of RBA speeches, Glenn Stevens on Tuesday, Guy Debelle on Wednesday. But the tone that we're getting from the RBA at the moment is very much wait and see. So with the unlikely to see a real drift lower in the Aussie from the domestic economy side of things, it all comes down to what's happening with the US dollar. and of course we've just been unable to see that US dollar move substantially or even move above those 12-year highs versus well, the basket of currency, the US dollar index. So that's why we look like we're going through a little bit of a pause, a bit of a consolidation pattern at the moment, and really over the next week and a half, I think if anything is going to really drive some activity in the Aussie dollar, potentially in the US dollar as well. It's probably going to come a little bit from left field. It's probably going to come from the Eurozone, and really depending on how we see the European Central Bank play out over the next couple of weeks, that could be the catalyst for a big move in the euro to the downside. That would see the US dollar benefit, and from that perspective, that might be the next trigger for the Aussie dollar to press lower. But certainly in the near term, certainly after that big candle, that big green candle we saw on Thursday's session, out of that downward sloping trend, it looks like the Aussie might try have a little bit of a drift higher, and we could be in a little bit of a range for the next couple of weeks.
I noted today that Mario Draghi is speaking later tonight, and of course we're only about 10 days away from the next ECB meeting. There's a reasonable chance that he might send the euro lower tonight. What are your thoughts about that?
Yeah, look, Andrew, I think for any traders out there that the euro definitely has to be the market to watch. I mean, have a look at the way it reacted back in January of this year when the European Central Bank started their quantitative easing program. It was just an absolute extreme movement. I mean, it was a tremendous opportunity out there for market participants. And of course, we don't know what the ECB is going to do, and it might lack the firepower that we saw back in January. But I think we really have to watch the way that the euro's been behaving over the last couple of weeks. It's clearly shifted to a downward mode, and you know, a break below that 105 level is likely to be the catalyst for another big substantial move lower. So I think for all the traders out there, the euro has to be the one to watch, and certainly most of the speeches that Mario Draghi has been taking part in over the last couple of weeks have ended up being euro negatives, and it's likely that he's going to continue to signal that further stimulus is on the way, particularly when you look at the inflation situation in Europe. They're stuck near zero. It seems very hard for them to gain any traction, and so I think from what we've been hearing, the likelihood of either a further cut in deposit rates or an extension of their quantitative easing program looks like it could come sooner rather than later. I think traders and market participants need to be prepared for that.
The US dollar at the moment certainly is most likely the most overcrowded trade in the market. It's had a stellar rally for the last few years now. And do you think the move last night lower on the US dollar was more about taking profit, and perhaps the Fed wasn't quite as hawkish in the minutes on Thursday, because it really didn't seem to be any real valid reason for the US dollar to shift so sharply lower, and that certainly helped the Aussie back high, didn't it?
Absolutely, Andrew, but you know, in markets, sometimes when markets want to do something, they'll grasp onto any piece of news, and then in hindsight we'll have to use that piece of news as the rationale for the move. So yeah, of course the Fed minutes did take some of the steam out of that US dollar trade, but like you said, that is one of the most overcrowded trades you know, in recent history, and it's very vulnerable to any shakeout in that movement. So I think that's what we really saw on Wednesday night. It's fascinating how, you know, the charts and the fundamentals always line up, but those Fed minutes came out just as the US dollar index was, you know, within a nose of those 12-year highs, and so the market was going to either look for a catalyst to push it higher or a negative for it to start to reversing lower. And once we saw it move lower, then that's the reason why we've seen such a massive move over the last couple of days. The Aussie's move has been really impressive, but the really impressive move out there has been on the New Zealand dollar, up 2.5% in 48 hours. And the New Zealand dollar was the currency that was getting hit the hardest in recent times by this US dollar strength, and of course that's the one that's benefited the most. So I think the US dollar trade, it's very vulnerable to the fact that it's overcrowded. And you look back on the history of when the US actually starts raising rates, well, the normal reaction normally is for the US dollar to fall, and of course that's quite counterintuitive until you look at the big rallies that we see before the Fed moves. These are really well telegraphed moves, and of course everyone gets in the trade beforehand, and then afterwards the market falls, sometimes even a little bit before that. So from that perspective, this crowded US dollar trade, I think it's quite vulnerable for a real volatile period over the next couple of weeks. That's good if you're very nimble as a trader, but it's going to be very dangerous if you're a trader if you have a wedded on, locked on view of what's going to happen rather than reacting to the market as it develops.
Steven, you've been spot on the money so far here on Money Exchange. We appreciate your time.
Great. Thanks a lot, Andrew. Appreciate it.
Time for a quick break. Some analysis when and what to expect when the US Fed finally lift rates with Tony Sycamore of Commonwealth Bank. Don't go away.